Today we are going to talk about generally accepted accounting principles, also known as GAAP. And these are the general set of rules that accountants and bookkeepers kind of go by. And for a long time, these really intimidated me because they seemed kind of like confusing and complex. And it kind of took me a little time to figure out what people were talking about when they would talk about GAAP. So I really want to kind of demystify these for you guys today, because as a bookkeeper, you should have kind of a general awareness of them. And I'm going to try to be as practical as possible about how they relate to your job as a bookkeeper. So basically there's this one board called FASB, and there's actually a couple of different entities that kind of would like to regulate this. But the one we're going to talk about is the FASB, and they sat down and they made these rules. And basically it's so that every company can be compared like on the same terms. So basically, like if someone want to invest in your client's company and they're comparing two different like doctor's offices, those two doctor's offices are reporting the same way. So they're easier to compare and everyone isn't just like making up their own rules about how to report on their finances. And so a lot of these rules are actually kind of common sense and they're going to seem familiar even if you haven't studied GAAP before. You'll be like, oh yeah, I kind of was aware that that was a rule that I was supposed to follow as a bookkeeper. All right, so the first one I'm going to talk about is the business entity assumption. And so that just means that the business finances need to be separated from the personal finances. So the business needs to be like its own like separate entity. And you probably know this as a bookkeeper. You probably have clients who are trying to mix personal funds and business funds occasionally, and you like give them a little slap on the wrist and say, that's not okay. I did talk about that in this video. The thumbnail looks like this, and it's all about like the worst clients ever. So like things about clients that are going to annoy you probably. The next one is called going concern, and that just means that the business is going to be in operation. It's not like on the verge of shutting down. So like the business will continue to exist in the foreseeable future. And number 3 is the monetary unit principle. So this just means the business is using a standard unit of money. So if you're in the US, it's going to be the dollar. If you're in another country, it's going to be whatever the dollar is in your country. But businesses can't just be like, oh, I'm going to use monopoly money, or oh, I'm going to value my business based on how much grain I have in my like farm's silo or something. You know, they need to use a standard unit of money. So you can see there's a list of the 10 that I'm going to talk about today. In my research, I did find that certain websites or businesses or organizations would maybe either call these differently, or they might have slightly different number, or they might just organize them in a different way. I found that Wikipedia had a really good outline of them. So I'll leave the Wikipedia linked down below, but they also divided them up into different like kind of sections. So the first was assumptions. So you kind of assume that the business is its own entity. And then the next was principles. And then there was constraints. So leave a comment down below if you have an even better resource for like a list of these, or if you know more history about why different organizations might call it different things. I know there's like an international board, and then there's the one that we use in the US. And then again, some of them are worded differently. So there was a lot to sort through. So I just did my best to try to get the most accurate overview for you guys. But definitely leave me a comment if I messed up any of these or if there's any mistakes that you hear. And as you know, as a bookkeeper, I have less schooling, less credentialing than an accountant would. So I think if you went to like school to be an accountant, you would learn these pretty well. And then also in some bookkeeper training, like if you take Bookkeeper Launch, which is my favorite bookkeeper training, they have a whole section on this also that really helps you just kind of get the background of things and the debits and credits. So don't feel like you totally have to memorize these or anything, just you need to have this general understanding, and you probably already know more than you think. And the next one is the time period principle, and that is just basically that the financial activities can be divided up into specific time periods. And I don't really understand like what the opposite of that would be, but it does really come into play when you're pulling reports. So, you know, you can pull up profit and loss for last year, you can pull it for this year, you can pull it for certain months, certain time periods, as well as a balance sheet that is just one day in time. Next one is historical costs. So this means that in the books, you're recording things for the cost that they were purchased. If your client bought a piece of land and it goes up in value, or if they bought like a car or something and it goes down in value, but it's important that you record it for whatever your client bought it for. And I haven't mentioned yet that my name is Morgan. My website is FinePoints.biz. I help bookkeepers organize their bookkeeping businesses. Check out my free masterclass. And I would love it if you subscribe to this channel, and a thumbs up really does help me out if you could hit the thumbs up button. The revenue recognition principle wants you to record all revenue when it's earned, not when it's received. This is also called accrual-based accounting. So in QuickBooks, you can click a little button and it'll pull your reports either in the accrual method or the cash basis. So as you know, sometimes there is a delay in payment. So you can buy something on a credit card and then you actually pay for it at a later date. Same with income that's coming in. So as a bookkeeper, maybe you invoice your client and it's due within 15 days. So let's say you invoiced your client for $500. And so in that 15 days, when you earned the income but it hasn't been paid, the accrual method or this revenue recognition principle says that you have to say, yes, I have that $500. That is part of my business finances at this point. So I have had a request for me to do a more in-depth video about accrual versus cash basis and kind of how to use them and what the pros and cons are. Let me know in the comments if that interests you and I can make that video for you guys. All right, next is the matching principle. I'm going to read you guys the definition. This one, it's harder for me to figure out how practically it would relate to me as a bookkeeper. Let me know in the comments if you had clients that you have a practical example for this one. But basically, its expenses are not recognized when the work is performed, but when the product actually makes its contribution to the revenue. So I think that might be something like if you're buying inventory and then, repurposing it and selling it. When you first buy it, it's not really a cost until you sell it. But again, let me know in the comments if you're able to explain that even more clearly. And then the full disclosure principle is pretty much what it sounds. Just make sure you're not leaving out anything out of the books, which again seems kind of obvious. The materiality principle, and this says that the significance of an item should be considered when it's reported. So basically, is this a big enough deal that it would affect someone's decision about the overall picture of the finances? All right, and then the last one I'm going to talk about is the conservatism principle. This is just when you're deciding to put things in the books, if there is some gray area, go with the thing that is the less favorable outcome to the client. So be more conservative. Don't try to make the books look a little bit better than they are. If you are choosing between those two things, make it look less favorable. And in studying these principles, I did find that they're really trying to be logical, and some of them have wording like, if it is not an undue burden, like something like that. Like do the best you can and be as honest as possible, but there is an extreme where we're not expecting perfection. Like that's me paraphrasing the general vibe I got from these. I think there's one that says if you're off by an insignificant amount, it's okay. And that's good to hear, because sometimes accountants, there's different personalities. Sometimes accountants are like, I need to have every single cent accounted for, and some are like, okay, these 2 cents aren't worth me spending hours figuring it out. So it was interesting for me to kind of go through these and familiarize myself even more with these general accounting principles. Thank you guys for staying all the way till the end. I know this maybe wasn't the most thrilling of topics, but it is really important for you to have a general understanding of. Give me a thumbs up if you appreciate this video, if you appreciate the work and research that I put into it, and I will talk to you guys again next week. Bye.